Today, we will explore the differences and essential roles of two significant institutions that shape our economies: the Federal Reserve in the United States and the Bank of Canada. While many people may assume they are quite similar, these central banks operate under different frameworks and priorities that influence everything from interest rates to the stability of our financial systems. Let's take a closer look of how these institutions function and what makes them unique. The Central Bank of Canada is not called the Federal Reserve. It is known as the Bank of Canada, BOC. Contrast, the Federal Reserve System, often referred to as the Fed, serves as the central bank of the United States. The decisions made by the Federal Reserve and the Bank of Canada influence everything from mortgage rates to the value of savings. Let's take a closer look at how these central banks operate. One key difference lies in their mandates. The Federal Reserve has a dual mandate: to promote maximum employment and stable prices. This means that its policies are designed to foster job growth while keeping inflation under control. Not bad. In contrast, the Bank of Canada focuses primarily on maintaining a 2% inflation target. Although both institutions aim to manage inflation, their approaches reflect different economic priorities. Their structures also differ significantly. The Federal Reserve consists of 12 regional reserve banks coordinated by a board of governors in Washington, D.C., allowing for regional economic considerations. Conversely, the Bank of Canada operates as a single institution headquartered in Ottawa, enabling it to respond more swiftly to national economic challenges. Policy approaches of these two banks can lead to divergent monetary policies. For instance, because most Canadian mortgages have 5-year terms, the Bank of Canada tends to be more sensitive to interest rate changes than its U.S. counterpart. This sensitivity can create different economic outcomes in response to similar inflationary pressures. Another important aspect is governance. The Bank of Canada is classified as a Crown corporation, meaning it is a government-owned entity that operates with both commercial and public policy objectives. This structure allows it some autonomy from direct government control, while still serving public interests. In contrast, the Federal Reserve functions as an independent entity within the U.S. government, without an equivalent structure like Crown corporations. In recent years, there has been a notable divergence in monetary policy between these two central banks. The Federal Reserve has been cautious about lowering interest rate due to the resilience of the U.S. economy, while the Bank of Canada has shown greater willingness to adjust rates in response to changing economic conditions. Understanding these distinctions is crucial for several reasons. First, Canada and the United States share a deep economic relationship. Approximately 80% of Canada's exports are destined to American markets. Changes in one country's policies can significantly impact the other. Additionally, U.S. policies can have substantial effects on Canada's economy, particularly regarding investments and trade relations. Moreover, recognizing these differences help maintain and improve diplomatic relations between both countries, which are based on shared geography and values. By appreciating how these central banks operate and influence their respective economies, we can better navigate the complexities of the relationship and address shared challenges effectively. In conclusion, while both the Federal Reserve and the Bank of Canada play vital roles in shaping their economies, understanding their distinct mandates, structures, and policy approaches allow us to grasp how they influence our financial lives every day.